There are a plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Himanshu Srivastava, Morningstar Investment Advisor India. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your queries on the Money Show at etnow.tv. Hi, good evening, Himanshu, and welcome to the Money Show.
Hi, Kavita. Thank you.
We are also joined by our first viewer on the phone line, Ritika Singh. Ritika, hi, good evening. How are you doing?
Hi, I am good. How are you?
I'm doing good. You're calling from where, Ritika?
I'm calling from Kolkata.
All right. So, as per the details sent by you, you're 24 years old and you want to start your journey in equity mutual funds. First of all, congratulations for thinking about this. And you're very young, in fact, the right age to start your investment. And I believe you're working? You're a working professional?
Yeah, actually, I'm a freelance copywriter.
Freelance copywriter. Oh, lovely. Any hit copies that you've written that we might just want to know about that?
I've written a few copies for website copies for Vassar and Constantine. If you would like to check that out, it's there on their website.
Definitely. Oh, wow. We are almost talking to a celebrity then. Okay.
No, not at all.
You want to invest 500 to 1,000 rupees per month. That's very nice. And you also wrote that it's going to be a long-term investment for at least 10 to 15 years. Right. Anything specific in mind after 10 to 15 years? Do you have a financial goal or is just wealth creation and you just want to begin, just start off with this journey?
I just want to start off with this one because it's just I'm beginning here, so I would like to begin with a very minimum amount, so I don't have to risk much of it. So that is why.
Okay, so I believe you read about equity mutual funds, you read about stock markets.
As I told you, I am beginning with this thing, so I know a few things about it, but well, it is a huge ocean, so
Definitely. It is, Ritika, and thank you so much for sending us your query. In fact, giving us an opportunity to help you with your financial investments. Himanshu, how will you help Ritika in starting off her journey?
Yeah, Ritika, frankly speaking, you still know the basic tenets of investing because given your query, you are for long-term focused, you want to start with SIP. These are the basic background. These are the basic foundation of to start investing with, and you clearly know all about that. So I would really like to commend you for, thinking that way. Frankly speaking, it's a good start. Even thinking in the right direction is a good start. And I'm very sure that you'll be able to invest wisely and create a long-term wealth for yourself. Since you are starting early, I think the best way to go about to do it is in the proper financial planning way, which is setting up the investment goal, setting up your investment objectives, doing asset allocation, selecting the right funds for your portfolio, and conducting regular reviews. Now, these are the basic format of this is a basic path for investing. But I do understand that you want to start with investing rupees 500 to 1,000 rupees, which is also very good just to test waters. I think there are three solutions that I can offer you. One of the thing is, since you are starting, you can consider investing in an aggressive hybrid fund. Now, these are those funds which invest 65% to 80% of their assets in equities and balance 20 to 35% in debt instruments. That way, the category provides you a standard asset allocation. So as an investor, you don't really have to actively manage asset allocation. And it's a good starting point nonetheless. Some of the funds that you can consider from this category are SBI Hybrid Equity and Kotak Equity Hybrid. Another option that I would like to suggest you, for example, if you don't want a debt allocation in your portfolio, you might have some cash in your bank account or you might have some FDs lying. Or even if you don't have that, you want to go all out into equity to start with. So I think where you can start is to invest in a large cap fund. These large cap funds are really stable in nature. So they prove to be an anchor's role in a portfolio, in an investor's portfolio during turbulent times, given the stability that they provide. In my opinion, they should be the major portion of the portfolio whenever you start building your portfolio. So some of the funds from the large cap category that you can consider are Aditya Birla Frontline Equity, Axis Blue Chip, ICICI Prudential Blue Chip, Kotak Blue Chip, Mirai Large Cap. There are quite a few good large cap funds available in the market, which you can consider investing managed by very well and experienced managers. Now, I'm not sure whether your income, falls into the taxable bracket or it's a taxable salary. I'm not sure about that. But if it is, then also you can consider investing some portion in tax saving funds, which will help you save tax under Section 80C. That is something that you have to decide. So these are some of the options that you can explore, and you can see where you fit in, and accordingly you can plan your investments. So this is the starting point as of now. Now, what I would recommend is as you progress in your career, you progress in your personal life, you have more money to invest. I think this is where you should start building your portfolio, and you keep on aligning your portfolio in line with your needs, investment objective, with the right asset allocation mix. That is very important. And the focus should also be on diversification. So going ahead, once you have more money to invest, you can start diversifying your portfolio and align this portfolio with one of the investment objective or goal. So you have target in mind. That is very important. Otherwise, a targetless investing is like means it may not lead you anywhere. So assign your targets and assign those targets with the portfolio that you are building. And I think that this should help you going ahead. And that's the ideal way of investing going, obviously.
So that's the word coming in for you, Ritika, and all the best for your investment journey. Himanshu, we move on and we will take Samiksha's question. And she says that she's been investing in SBI small cap since last year, and the fund has been underperforming as compared to its peers like Nippon Small Cap. And she wants to understand if she can still stay invested in this fund. The time horizon is long term for her.
Yeah. As a long-term investor, Samisha, you should understand that every fund has a cycle. It goes through a cycle. Every fund is run with a strategy. Every manager has a different investment style, investment approach, and there will be times when that style or that approach or that strategy may go out of favor, and it may not deliver returns in line with our expectation. That's okay. If the underperformance is due to anything fundamentally not wrong with the fund. If there's something fundamentally wrong, then it's something that then it requires obviously a relook. But if there's nothing fundamentally wrong, then I think you should consider investing in a fund. In case of SBI Small Cap Fund, I don't think there is anything wrong there. The fund is managed by a very experienced and veteran fund manager. His name is R. Srinivasan. He's one of the most prominent managers in the Indian mutual fund industry and expert in mid and small cap investing. He's supported by a team which is equally strong, and it comprises of experienced managers and analysts. Even if you look at the investment strategy, it's quite robust. The manager runs the portfolio with a bottom-up approach. He shortlists companies that can generate high growth on a sustainable basis. So obviously there is a quality bias as well as there is some growth bias out there. So these are fundamental attributes of the fund which has remained intact for a really long period of time. Obviously, there are certain risks given it's a small cap fund. It could face liquidity issues in some of its holdings, which are less liquid in nature. So during market downturn, when there's challenge to the liquidity, the fund may witness some challenge. But at the same time, if you look at the history, it has a long history, and it has seen all those cycles. It has come out of it and has performed well as. However, to manage one thing that I would like to point out here is to manage this risk. The fund house has actually stopped or restricted flows into the fund. So that is a very investor friendly move, in my opinion. Now, while looking at a performance, you should also understand that performance is just one factor, but it's not the only factor. It should never be the topmost factor to select a fund. The fund should have a strong manager, team, and well-defined and robust investment strategy, which has weathered a test of time. These are the foundation of a fund, and if these things are in place, then performance would follow. But when I check the performance of this fund, and the performance of this fund is not actually bad. Obviously, in the recent times, it might have faced some challenges, but over a long term, and that's what the ideal time frame that you should be looking at for this fund, the performance is good, and it has been able to outperform the benchmark index as well as category peers. So I would recommend you to stay put in the fund. There is no need to panic or redeem your investments. However, from the diversification perspective, going ahead, if there's is a need in your portfolio, then you can add another small cap fund just from the diversification perspective out there. Now, here's a piece of advice for you before we move to another question. Comparing your investment with the top performing fund in the category is like inviting disappointment. So you should also know what is the right comparison for the fund or how the fund should be compared. If a fund has been able to outperform its benchmark index and category peers over a longer period of time, and that should be fine. and that is the ideal way of doing it. So equity funds, also looking at equity funds from a 1 year perspective or the performance over a 1 year perspective and taking decision based on that is not a prudent approach. So be long term, try to understand whether the fund is fundamentally sound or not throughout your investment journey. And if it's fundamentally sound, if it's doing the same thing that it has done in the past, then I think underperformance would come at times, but over a long term, the fund should be able to deliver outperformance.
All right, so for now, you can stay put in the fund. We move on, Himanshu, and we will take Lokesh's question from Bangalore. And he has invested in SBI Contra Fund for a long-term purpose, and mainly 10 years or so is his time horizon. He wants to understand if investment is good for him. Obviously, we need to know what kind of portfolio he has, but then just talking about this fund, what kind of investor should be putting this fund in their portfolio, and what is this fund like?
Okay, I'm not sure whether Mr. Lokesh has a portfolio intact or not. If it's not, then ideally he should invest in regular diversified equity funds from other standard categories like large, mid, small, large and mid, flexi cap, multi cap. The reason is contra funds are kind of theme-based funds. They are thematic funds which follow contrarian investment style. And what is that? These funds focuses on companies or sectors that are normally overlooked by investors and are available at reasonable valuation. So if in a well-calibrated approach, if the strategy does well, if it manages investment call goes right, then they may generate strong return, but at the same time, risks are equally high. But if you have a portfolio in place, then from a diversification point of view, an investor can have some portion in these funds, but these funds cannot be a part of your core portfolio. They can be a part of your ancillary portfolio or satellite portfolio, but not a part of core portfolio, given the risks that are involved, given the seasonal kind of a nature that these funds tend to have. Now, if we look at the contra category, there are just 3 dedicated contra funds, and SBI Contra Fund stands out within that. So if Mr. Lokesh doesn't have a portfolio in place, then I would recommend not investing in SBI Contra. He should rather go for a regular way of investing. But if he has a portfolio in place, then he can consider investing some portion in SBI Contra Fund. The performance has been good. So that way, I think that is how I would recommend how he should approach this investment.
We will take Danish's question, and he wants to invest for 6 to 8 months where he can get under 10% return.
I think he has a very specific requirement of 6 to 8 months as an investment horizon. So obviously, equity funds are certainly out of question. So they are completely ruled out. The best way to go about investing in this case is selecting some of the fixed income categories which have less than 1 year of investment horizon. For example, funds from ultra short, low duration and money market, and that will be more suited for him. Some of the funds that he can consider are ICICI Prudential Ultra Short Term Fund, Axis Ultra Short, Kotak Savings, SBI Magnum from the Ultra Short category. From the low duration categories, ICICI Prudential Savings, SGFC Low Duration, Kotak Low Duration. These are good funds. Even from money market, SBI Savings, Kotak Money Market, Axis Money Market. These are some of the good funds that he can consider investing. As far as return expectation is concerned, it's very difficult to predict. However, by investing in these categories or in these funds, his risk will be on the lower side, and he will be able to reach closer to the target return that he is aimed for to achieve. So I think this is how he should follow. I don't think there's any other better way of going ahead in this kind of a situation.
All right. So talking about investment for such a short period, the focus should be on earning returns or maybe just having your capital secured.
Capital secured. I think capital security is one of the best, one of the things that over a short period of time one should focus at. And that's why we don't recommend equities, largely because the last 6 months or 7 months have been great for equity, but who knows what lies ahead. And there the chances of capital erosion is much higher. Unlike in case of debt funds or these categories, where your capital will most likely be preserved, but at the same time you will be able to earn some returns which will help you achieve your return target. So I think in such a short period of time, if you want to invest, capital preservation should be the main objective of investors.
wants to have a slightly longer or maybe medium-term outlook in a debt category, okay, how would you recommend that kind of a placement in their portfolio, looking at their interest rate scenario right now?
I think that way, if you look at short-term category and medium duration category are pretty strong. Medium duration category used to be a pseudo credit category earlier, but now the credit exposures have toned down quite a bit. Most of the funds take 20% or 30% of exposure in lower rated papers. So, but otherwise, if you have some risk appetite there, medium duration category funds are also good, and those lower rated papers provide a kicker to the portfolio where the returns could be relatively higher than the short-term category. So I think short duration fund and medium duration fund, even combined together, will be a really good option for those investors.
Interest rate scenario, a longer term bet in debt mutual funds will not be a good idea?
I think there you need to invest. You can consider dynamic bond fund.
Okay.
We still are not very sure when we see an interest rate cut, although we have peaked. But as you see, we were expecting, a pause, a relatively longer pause with the US interest rate, but US Fed has just hiked rates, and that could also lead to RBI hiking rates. So we still don't know whether we are at the peak of the interest rate hike cycle or we have reached a pause. So in such an environment where there are uncertain times, you can't really take a call on a longer duration at this point in time, until there's more clarity in place. What one can do is one can invest in dynamic bond funds which can manage their duration dynamically. They have better flexibility in terms of looking at the interest rate environment. The managers have more visibility out there, and they can reduce duration as well as high duration based on how the interest rate scenario is panning out. So I think that way, dynamic bond fund could be considered. But normally in uncertain scenario where you are not very sure how the interest rates would pan out in the next, say, 7, 8, 9 months, then I think being on a shorter side would be more a cautious kind of an approach, but more advisable at this point in time. Having some allocation dynamic bond fund would not hurt, just in case if there's a sudden change happens and and there's sudden chance of making some returns.
There is no interest rate risk attached to dynamic bond funds. Is that what you're trying to say?
No, there is. That's why I'm saying that there is interest rate risk, definitely. But that interest rate risk is managed by manager, right? So a manager can go down to, say, 1 year or 2 year of maturity. But at the same time, if he sees there's an opportunity to make at the higher end of the yield curve, he can increase the maturity. So the interest rate risk is managed by the manager. Whereas in the short-term categories or something which is lower than short-term categories, the interest rate risks are low. But in dynamic bond fund, interest rate risks are high. Because here we are obviously relying on the manager that his investment call is going right.
Himanshu, I think that will be all. Thank you so much for taking time out today and helping our viewers with their financial portfolio queries.
Thank you, Kavita. Thank you for inviting me. Really
time to sign off from the Money Show, but then we leave you with our WhatsApp number and our email ID where we keep waiting for your portfolio related queries. Thank you so much for watching. Goodbye.